Okay, similar to the previous example of a deferred tax liability, we're going to walk through an example of a deferred tax asset. Again, this is just hopefully it will illustrate some of the concepts we've been discussing in the first couple of lectures, and we'll start to bring all the information together. All right, so the definition of a deferred tax asset is a deferred tax asset represents the increase in taxes refundable in future years as a result of deductible temporary differences at the end of the current year. Much like the previous definition for deferred tax liabilities, we're going to break that down a little bit into something we can better understand. Again, sort of highlighting the two areas that I think are most important about the definition. It's an increase in taxes refundable, and it's a deductible temporary difference. And so if you recall with the deferred tax liability, it was an increase in taxes payable, and it was a taxable temporary difference. And so you can see now we're talking about refunds and deductions rather than payments. So the implication is that there must be some net asset, some underlying net asset that is temporarily less under US GAAP compared to that same net asset under the Internal Revenue Code. So it has to be the case that either there's some sort of revenue under the Internal Revenue Code that will be recorded later under US GAAP, or there must be an expense under US GAAP that will be recorded later under the Internal Revenue Code. Again, both the revenue or the expense is derived from the net asset. But again, this difference is temporary, and you can kind of see if you compare it to the deferred tax liability, we're kind of going in the opposite direction. If something covers multiple years, similar to the deferred tax liability, and we will use it in this example, you do have to focus on the cumulative effect. In other words, you have to focus on the balance sheet to make sure that you understand whether you have a deferred tax asset or whether you have a deferred tax liability. All right, so here's the example. So in this case, 49er Company sells magazine subscriptions that are all paid 1 month in advance. At the end of 2020, 49er Company had collected $4,500 in fees for deliveries that will happen in 2021. They had a similar situation in 2021, only for $3,500 that time. And they did change their policy in 2022 so that there were no prepayments in 2022. The Internal Revenue Code records revenue when the cash is collected, while under US GAAP they wait until the magazines are actually delivered. And then we have information for pre-tax financial income under each year 2020 through 2022. And so we're going to kind of do the same framework we've been doing all along, and we'll get to the journal entries for 2020 through 2022 for the income tax. Again, three important elements whenever you're approaching a journal entry. First of all, you have to calculate your taxes payable. Again, reconciling pre-tax financial income to taxable income. And the second thing is you have to calculate any change to the deferred tax asset. Again, you have to identify and calculate the tax effect from any temporary difference between GAAP and the Internal Revenue Code. In this case, it's going to be those magazine subscriptions that were paid in 1 year for deliveries that won't happen until the next year. And then finally, you derive your income tax expense as a plug in the journal entry. Again, for simple examples, this might be a little tedious, but for more complex examples, it makes a lot more sense. All right, again, looking at 2020, I highlighted the two most important numbers there. First of all, it was the $4,500 that had been paid but not delivered, and of course, pre-tax financial income of $120,000. Okay, so we start with the 2020 pre-tax financial income of $120,000. Of course, the $4,500 that had been collected in 2020 for subscriptions that would be delivered in 2021 would be unearned revenue under US GAAP, but it's earned under the Internal Revenue Code. Therefore, there's going to be a difference between pre-tax financial income and taxable income. And so the Internal Revenue Code taxable income is $124,500. We apply the tax rate of 35%, which gives us our income tax payable, $43,575. So the next step then is to get the calculation for the deferred tax asset. Again, we focus on the balance sheet for this calculation. And so we have the book value of the GAAP unearned revenue. Now notice in this case I have a negative $4,500, and the reason why is because within this framework we want to be thinking in terms of net assets, and net assets is assets minus liabilities. And so since unearned revenue is a liability, the balance or the book value under GAAP of the net asset related to the unearned revenue is negative $4,500. The reason why I do it this way is so that we can use a consistent framework whether we're dealing with liabilities or whether we're dealing with assets, rather than having to flip everything around. And so again, we're just trying to be consistent with the calculations we've been doing all along. And so under US GAAP, we have the unearned revenue account balance of $4,500. There is no unearned revenue under the Internal Revenue Code because they record everything that's been collected. So there is a difference in book value of this liability of negative $4,500. Now that negative sign indicates that the income effect is negative rather than positive. And what that essentially means is that the cumulative income under the Internal Revenue Code is more than the cumulative income under US GAAP. And so unlike a deferred tax liability in the Internal Revenue Code is greater, rather than with the deferred tax liability, US GAAP is greater. So you can see that the sign is flipped, which indicates we're in a different situation than we had focused on in the previous lecture. Same process from here forward. We apply the tax rate. And again, instead of a DTL balance, we're looking at a deferred tax asset balance of $1,575. We compare that to the previous balance. It's the first year, so there is no previous balance, which means we had a change in the deferred tax asset. This is the entry amount, or an increase of $1,575. And of course, that is the income tax effect. So now to our journal entry for December 31st, 2020. We start with our income taxes payable, $43,575. And we have our entry for our deferred tax asset, $1,575. And we derive our income tax expense of $42,000. Now we kind of grab onto the same conceptual framework again just to kind of tie this together, and we can see again the book value of the net asset under US GAAP is negative $4,500, which is less than zero under the Internal Revenue Code. The implication then is that accumulated income must also be less under US GAAP when it's compared to the Internal Revenue Code attributable to this specific item. And so the subscription revenue would not have been recorded under US GAAP, and of course $4,500 would have been recorded under the Internal Revenue Code. So if you look then at the accumulated income tax effect, you can see there's no effect under US GAAP because there's no income, but there is an income tax effect under the Internal Revenue Code of $1,575. So just to kind of remind ourselves of some of the verbiage that we use within the chapter. So in 2020, we do have a total income tax expense of $42,000, and there are two components. The current tax expense, which is the amount of taxes paid in the current year, $43,575. And because we have a deferred tax asset, we do have a deferred tax benefit rather than a deferred tax expense. And so that's the portion that's going to be deducted in the future, which is $1,575. So now we continue into 2021, but there are two important things, or sort of two pieces that are important here. First of all, you have the collection of the subscription fee, you have the fulfillment of the magazine subscriptions from 2020, and then you have some additional payments where the delivery will not incur until 2022. And so there's really two pieces: the $4,500 left over from 2020 and the $3,500 from 2021. And of course, our pre-tax financial income is a little bit different, so we need to pay attention to that as well. So in 2021, we start with our pre-tax financial income of $115,000. And then we have that 2020 unearned revenue. Now remember, we're trying to go from pre-tax financial income to taxable income. And so within US GAAP, they would have recorded the $4,500 in revenue in 2021, but it would already have been recorded under the Internal Revenue Code in 2020. And so we need to subtract that off the pre-tax financial income. And of course, 2021, there's the unearned revenue, that $3,500 that was paid but not yet delivered. And so we have to add that on again in order to reconcile pre-tax financial income to taxable income. So our Internal Revenue Code taxable income is $114,000. You apply the tax rate, which gives our income tax payable of $39,900. Same framework we've been using all along. The book value of the GAAP unearned revenue at this point in time would be $3,500. Again, it's negative because this is a liability. There is no liability under the Internal Revenue Code. Therefore, the difference in book value is a negative $3,500. Now, this is a cumulative income effect because now, of course, there are 2 years that we've been dealing with this issue. We apply the tax rate, and that gives us the new balance for the deferred tax asset. Again, this is the cumulative income tax effect. We subtract the previous balance, which was $1,575, and that gives us the change in the deferred tax asset. It is smaller. It's reduced by $350, and that is the current income tax effect. So then we get to our journal entry on December 31st, 2021. We start with our income tax payable of $39,900. Then we have the entry for the deferred tax asset. Again, that deferred tax asset is getting smaller, so we're going to credit the account for $350, and we derive our income tax expense to be $40,250. Throwing this into the framework, again, we have the unearned revenue account balance of $3,500 under US GAAP. There is no unearned revenue under the Internal Revenue Code. But now, just sort of coupling this subscription revenue together, we can see that this delayed payment, we would have recorded $4,500 under US GAAP, but we actually would have recorded a total of $8,000 under the Internal Revenue Code, the $4,500 in 2020, and additional $3,500 in 2021. And so each of them does have an income tax effect, but you can see the US GAAP income tax effect is less than the income tax effect under the Internal Revenue Code. And of course, that difference is $1,225, and that's the balance in the deferred tax asset account. All right, for the final year, we have to worry about the collection of the $3,500 left over from 2021. And of course, pre-tax financial income is different in 2022, and so we need to take that into account. So we start with pre-tax financial income of $111,000. We have to subtract off the unearned revenue, again, because it would have been recorded under US GAAP in 2022, but it would have already been recorded under the Internal Revenue Code in 2021. And so we're trying to reconcile pre-tax financial income to taxable income, and so we need to subtract that unearned revenue off. And so the IRC taxable income is $107,500. We apply the tax rate of 35%. Which gives us income tax payable of $37,625. Again, now since we don't have any outstanding deferred tax asset account balance, the book value of the GAAP unearned revenue is zero. Of course, the book value of the Internal Revenue Code unearned revenue is also zero. So there is no difference in book value, which means there's no deferred tax asset balance, there's no difference in cumulative income, and there's no difference in the cumulative income tax effect. Now, there was a previous balance of $1,225, which means there is an entry to the deferred tax asset in 2022 for $1,225 as a reduction to the deferred tax asset. So looking at our journal entry, we start with our income tax payable, $37,625. The entry to the deferred tax asset, $1,225, which gives us our income tax expense of $38,850. Again, just tying it all together in the conceptual framework, we see that there is no balance in unearned revenue, therefore they are equal, which means accumulated income must also be equal. And of course, it's the 4,500 plus the 3,500 for a total of 8,000. And because the subscription revenue is equal, it must be the case that the income tax effects are also equal, and they are for $2,800.